My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. What are the most important stocks in this market? The ones that define the moment, show you where the money's going. After a mixed day where the Dow gained 71 points, the S&P declined 0.28%, NASDAQ lost 0.52%, notable outlier. I want to explain how I choose the stocks I highlight when I come on air every morning on Squawk on the Street, so you know what I think's really going on before the bell and then right after it. You know, I'm always looking for names that are both important and possibly investable for you, okay? The process is a complex one. First, I want to capture the zeitgeist. There are two major themes going on right now. Supply chain disruption, you read about that a lot, right? And that's including energy shortages. And then the fact that interest rates are going higher. They went up 6% last week. That's a lot. You need to know about these two themes every minute of every day if you're going to pick stocks, because that's what's driving the averages. I also try not to mention the same stocks that we've already been discussed here. You don't want overkill. I know a lot of you watch that show. It also means eliminating many situations we talk about at the top of Squawk on the Street. With interest rates going higher, you know the banks are going to do well. That's become a duh moment because this market isn't about being clever. So people just buy the banks without question, as they're supposed to be the obvious winners here. Buy, right? Of course, this is just a knee-jerk reaction, and these are often nonsensical. Sure, the banks should be making more money, but when they actually report in 2 weeks, their earnings numbers will have nothing to do with the current long-term interest rates at today's. This is already has nothing to do with the quarter. It's all about what happened over the last 3 months. The banks have been a disappointment relative to their stock prices because they often run, just like now, on some kind of theory that has nothing to do with earnings, but has more to do with the zeitgeist, okay? When we get the actual numbers, they could easily disappoint because expectations have already been ratcheted up. Now, lots of people confuse these two things. I want you to understand this. They say, we get a lot of calls like this, a lot of emails. Company beat the expectations. Why didn't the stock go higher? The answer is often that the stock ran into earnings because of moves like today, which are divorced from the actual reporting numbers. The expectations are just what the analysts are looking for. They don't necessarily represent what investors are looking for. Long story short, I wasn't going to mention the banks on Mad Dash or Stop Trading because now they're well covered. It really just doesn't do any good for me to cover them some more. Next up, oil. This one's pretty straightforward. Both oil and natural gas have been going nuts. They've been huge winners in the first 9 months of the year. Nothing's changed, just gotten better. Oil just keeps going relentlessly higher. Why? Because American oil producers have finally gotten religion on spending. They don't just burn all their money by endlessly drilling like they used to. Instead, they're returning capital to you, the shareholders, at an impressive pace. That means you might want to buy one of my favorites, maybe Chevron for the consistency in the dividend, Devon for its potentially huge variable dividend, or Pioneer Naturals for the same reason. Even Diamondback Energy, symbol FANG, has a new, more conservative posture that includes a major return to capital. I also like Conoco because of that acquisition they made last week. They're buying Royal Dutch's acreage in the Permian Basin at a ridiculously low price, because Royal Dutch is basically being forced to sell it by regulators in the Netherlands. Oh, yeah, and if you really believe we're looking at a long-term natural gas shortage overseas, you can speculate with Tellurian. That's Tellurian, the company that Sharif Suki started after he left Cheniere Energy, the liquefied natural gas export powerhouse. Given that there are huge natural gas shortages in both Europe and Asia and they're not going away, maybe our prices are a steal because we've got plenty of natural gas. Now, remember, I'm in a whirlwind of thought about what to say at 9:30, and now I talked about buying these oils last week, so I'm not going to go and hit them again, right? I'm not going to repeat what I said there. That's not interesting enough for me or you. This show flies. We hit China, and we mentioned that Tesla's going full bore in PRC, even with the Evergrande fallout. I said I think Tesla can go higher, and it's giving us a nice umbrella to the whole electric vehicle complex. That's Lucid, that's Fisker, Polestar, a new one that's coming public via SPAC merger. Tesla's now worth nearly $800 billion. It's starting to make a big move up. Lucid's at $42 billion. Polestar is going to have an enterprise value of roughly $20 billion. I suggest that the lowly Fisker should be bought at $14 and change. Good call. It then jumped more than 5% today. which brings me to the mad dash. Since we've covered China and we've covered the banks, we've covered oil, can't be any of those. Now, I had talked earlier about an emu that I thought about adopting this weekend when I went to the Last Chance Ranch. Okay, it's not that far from my place in Bucks County. And the producers put up the emu for a couple of laughs. Why not? The emu was really kind of funny. And then I went to the prize. And the prize was Micron. Not Tesla, which has been covered, not the Chinese, not the dollar, and not oil, but Micron. See, I told David Faber that the big commodity semiconductor company reports tomorrow if it's going to be, and if it could be down big on earnings. If it reports a good number, though, I think it can really fly. However, I mentioned that there's a chance Micron reports an inline number and then lowers its forecast. How the heck, you might ask, is that possible in the middle of a semiconductor shortage? Simple. Not all chips are the same. Micron makes DRAMs and flash, two low-margin kinds of chips that are quite abundant here. That makes their earnings problematic. More important, the semiconductor stocks are pretty weak away from AMD. Any upside surprise could send the group higher. Even if there's no good reason for them to trade higher, they don't trade together. Micron trades separate. Now, what is this about? Well, wait a second. They're all bunched together in ETFs. So Micron's the one to watch because when it reports tomorrow night, it's going to define this most important group. Why mention it this morning? Because the analysts are all talking about it, and I wanted to get ahead of the quarter. So Micron stays as Cramer's mad dash. Okay? When we came to the bell, the noticeable weakness in tech had to be commented on. I simply pointed out that you can't have higher interest rates and at the same time have growth stocks go higher. It just doesn't work. They're not compatible. Once again, the banks roared and the oil skyrocketed, but even the travel and leisure stocks jumped. Now, that's very unusual. See, travel and leisure is jumping even though oil and gas is jumping, but they're not trading like they should. See, the latter is going up because COVID has peaked. That's what people think. Now, remember, peaking and being beaten are two different things. We're going to speak to Dr. Scott Gottlieb, former FDA head, who's written an amazing book called Uncontrolled Spread later in the show. Now, he predicted a peak, but that does not mean, you should take a bow, but that doesn't mean it's finished, all right? Now, I know the airlines and cruise lines are on fire, but that it might be best to buy American Express because there's both travel and interest rate exposure. Look, when we're trying to figure out how to be bank, how to be dollar, how to be all these. No, wait a second. American Express. You see, here's the problem, though. I had hoped to save American Express for stop trading. That's the 955 one. But now that it was out, now that I mentioned it, got to toss it out. That puts my brain into overdrive. I am now getting frantic about what to say when Carl turns to me and says, Jim, what are you going to think for stop trading? But you know what? I'm not out of bullets. Earlier today, Piper named Best Buy a best idea. That was the perfect way to end the show because I have met with Best Buy CEO Corey Barry, who has spent a fortune making sure that the store can handle any supply chain interruptions. And she did it well before what's happened now. That's so foresight. That plus Best Buy's got some incredible new services, including what amounts to your own personal IT department when you work from home. Sure enough, the stock rallies $5 and then leads the retailers up, aided by the feeling that the Delta variant has peaked. So the great reopening trade is back on. Yes, we're going not with travel and leisure, already ruined that, couldn't do American Express. Sticking with the Micron, that stays in the picture. And then Best Buy turns out to be this was my stop trading. Well, my handwriting is so bad, but trust me when I say that this was my stop trading and this was my mad dash. The bottom line, bam, bam, bam. Micron for tomorrow, Best Buy for today, and a whole lot in between. That's Squawk on the Street from Monday, and it's on the Mad Money for the rest of the day.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.